Hello class, today we want to begin the last legs of our course this semester, and we want to now look at final accounts. I'd indicatively mentioned that we will be clearing them up, of course now with adjustments as it is. We will be looking at the statement of financial performance, statement of financial position, of course with adjustments for both the income and the expenses, be they accruals, that is the ones that we have earned in terms of income and we have not received their money, or for expenses, accruals, the ones that we have actually expensed, as in we have actually incurred them but we have not paid for them. And of course, for prepayments of the same, incomes that has been prepaid, we have received in advance and we have not earned them, and of course expenses that we have not incurred yet we have paid for them. And of course, I mentioned in our previous class about the timing differences, looking through into when particular assets were bought in an institution, and of course that gets exactly actually on the attention to detail. So I will probably now give out what I would call some problem over here that we'll be looking through. I think I'll dictate it and then we will be solving it on this particular Excel sheet to see the arrangement and the format of this particular statement that we're talking about. So let us pick up this example. The following trial balance was extracted from the book of KK on the 31st of December 2004. They were extracted from the books of KK on the 31st of December 2004. Of course, now the trial balance that has the details column, it has the debit side, and then it has the credit side. So we have all these issues. So we start with, and of course, all of them are in Kenyan shillings. So let me just start there with sales. And sales, the figure there is 360,000. Then after sales we have of course, as I was telling you, someone could even do purchases and sales, stroke sales. So when we do that, purchases and sales, that means one of them would be here. So let me just write that 170,000. Oh, sorry, that should be 170. So let me get rid of that. Then we have returns, and then these returns we have 10,000, and on the debit side and on the credit side we have 9,000. Then we have rent, and rent is on the debit side 8,000. Then we have advertising, and advertising, the figure there is 12,000. Then after advertising of 12,000 we have commission, and it's a credit of 4,500. Then after that commission we have accounts payable. We have accounts payable stroke accounts receivable. Accounts receivable, so let me just enlarge that line. So we have the figures there as 27,000, and this one here as 32,000. Then we have the next thing there is stock inventory. Inventory as at 1st of January 2004, and then the figure there is 30,000. Sorry, that should be 30,000. Then our next thing there is which one is that? It is insurance. And insurance is a debit entry of 15,000. And then we have drawings. Drawings is a debit entry of 20,000. Then we have furnitures and fittings. So we have furniture and fitting, and the figure there is 50,000. Then we have a cash in hand. Cash in hand, the figure there is 7,500. Then we have premises, and the figure there is 200,000. Then of course we have our capital, and the figure there is 144,000. Just like I think something where we read the 144,000 in the Bible. The book of Revelation has that 5. So our Nini debit side adds to that, our credit side again also adds to that. So that means our balance sheet balances. Let me make that a little bit bolder, and then I underline it. So that is our trial balance that we have been given. Then where the devil lies, where I'm saying the juicy part of accounting is where we now have additional information. And our information number 1 is on inventory. Inventory as at 31st of December 22004. And the figure there that we are given is 26,000. Then we have number 2, we have our rent accrued. And the figure there is 3,000 shillings. Then number 3, we have our insurance paid in advance. And the figure there for the insurance paid in advance is 2,000. Then we have number 4 and commission due. Just write it there nicely, commission due, and the figure is 2,500. And then lastly, number 5 is salaries owing. The figure there is 10,500. So we are required to prepare a statement of comprehensive income as in financial performance, and then the statement of financial position. So those are the things that we're required to do. Then now let me move into the next sheet, and we look through into how to prepare this particular statement. Of course, we are done in class, so I'll just have the first one there, statement of financial performance. And of course, as we were mentioning the other day, this should be KK, like if it is this is KK limited statement of financial performance for the year ended 31st December 2004. Let me just probably pick up those ones, and then I do it nicely. I think up to there, that would be fine. This also would be fine there. So this one, let me just make it there. Okay. So we have it there. So we start with the first thing, and I said in that particular statement, our first line of discussion is sales. So we have sales. Of course, in our format, it is less sales returns, or returns inwards. But in our case, we don't have those. We have returns. So it is sales less sales returns. So we have it there. So let me just pull this so that it becomes our figure for sales. If you look at what we have there, the sales we had been given as 360,000. Our sales returns in our question, our sales return is on the, if you check on our trial balance, our returns are here. One is on the debit and the other one is on the credit. This one here on the debit side is our sales returns. It is the opposite of the figure for sales. Similarly, this one here, the 9,000, will be our purchases returns, which is the opposite of purchases. I was telling you about the salsa kind of a dance, a twist on whichever side of the day. So we come over here and now we have our sales there, less our sales return. So we just subtract our figure for the sales return, which is 10,000. So when we subtract that, and then we end up with our figure of 350. So that is our net sales. This figure for net sales, now we now subtract less cost of sales. Cost of sales. And when you subtract your cost of sales, you end up with a gross profit. When you subtract your cost of sales, you end up with a gross profit. Of course, let me move this slightly. I think I can bring this to the extreme end there. So we have them there. Try just make it slightly bigger so that we can be able to follow. So we are saying this is less cost of sales. So let me just put this so that I can I can still see it. Okay, so what's our cost of sales? Cost of sales is normally opening inventory. Opening inventory, and our opening inventory is we have been given the figure there for opening inventory, and the figure is 30,000. I'm just trying check it in our opening inventory. The figure is there, that is 30,000. So that's what we have there as opening inventory. I'm just highlighting it so that we pick it up there. So our opening inventory equals to, you can even map the map. That's the beauty of Excel. Our opening inventory is 30,000. Then we are adding purchases, and purchases we don't have any carriage inwards, so we just have less of those returns. So our figure for purchases, when I come over here, purchases is here 170,000. Then we are seeing less returns, and this is returns outwards, and the figure here that we are subtracting equals to minus 9,000. So that's the figure that we are having there. So when we do that, we adding this, so this becomes our net purchases. Our net purchases is this particular figure there, so that will be that minus that, and the figure will be 161. So when we add this, our totals here of 191 is what is known as cost of goods available for sale. Cost of goods available for sale. Yeah, so that's our cost of goods available for sale. Cost of goods available for sale. Then we come to less closing inventory. Closing inventory, and we had been given the figure in our additional information, the juicy part of our account, and the figure there is 26,000. So when we subtract that, we now end up with our cost of goods available for sale. So that will be that 191, of course, minus the 26. So we have there 165 is our cost of sales. And of course, now we are subtracting to get our gross profit. Our gross profit. So our gross profit is what we have indicatively there. It is 350 minus this 165. So we will have it there. So we have our 350 minus 165 there. So that is our gross profit. That is our gross profit, 185. 185. If you look through on our trial balance, everything on the credit side, as we have indicatedly said the other day when we were doing our debit and credit in our asset equation, in our accounting equation, where we said assets equals to capital plus liabilities, and we said on this other side, on the debit side, we have expenses. On the other side here, we have income. So again, you will be able to see we have already used our sales, which is like money coming in. Of course, the purchases returns out, reduces the purchases. Then we have something here on the credit side. We have commission, that is income, or we have accounts receivable, that is money that we will still be accounts receivable, money that we will still be receiving from other people as paying other people as it is. So we look at our 4,500, that is the commission. So we come back to our gross profit over here. So we add commission. So we have a commission income, and the commission income equals to, we had been given there, the figure is 4,500, but there is some devil to it that we are looking through. There's some attention to detail where the juicy part now comes in. We are told there's a commission due. So there's a commission of 2,500 that we have earned, but we have not received. So we need to now recognize it. So add commission due, add commission due, and the figure that we have been given there, it's in our additional information, that is 2,500. So we add them together to give us that figure for the total commission, that is 7,000. So when we add the two of them here, when we add them, that gives us 192. 192. So this 192, we say less expenses. Less expenses. So expenses that we have over here are one of them is let me just get to our trial balance. Expenses now are on so this particular one for commission to me already. Then expenses, so our first expense are from here, and one of them here is rent. So probably I think let me use another color to pick them up, and I'll use that particular one there. So we have rent. So we have rent as a first income, the first expense. So we come over here and we say rent, and our figure for rent there is equals to this particular figure. Let me see whatever we have there. The rent is 8,000. I want to come and check if you have some additional information where we are doing. So there's a rent accrued that we have already incurred, but we have not paid. That is 3,000. So we come over there and say we are adding rent accrued. That is rent that we have, a house that we have lived in, but we have not paid the rent, and the figure there is 3,000. So our total rent will be a total of 11,000. Then the next expense in our trial balance is advertising. The figure there is 12,000. So I come over here and I say advertising. Advertising, and the figure there, I doubt if there is any adjustments to advertising. There is none. So let me just say equals to the figure for advertising, which is 12,000. Then our next expense on our trial balance is insurance of 15,000. So I come in and I say insurance, and let me just check if there's any additional information. There's an insurance paid in advance of 2,000. So there's an adjustment, so I need to make. So our insurance there, the original one from the trial balance, is 15,000. Then now we subtract less insurance, prepaid. It is paid in advance, prepaid. And we subtract that, and our figure there for that insurance is 2,000. So again, when we come in here, our total insurance will be 13,000. It will be 15,000 minus that particular 2,000. Then our next expense after insurance, of course, drawings will go to capital. We have furnitures and fittings, which is an asset. We have a cash in hand, which is an asset. We have a premise, which is an asset. And of course, we have capital. Then there is something here that we have that we have not been given. Commission due we had used when we were adjusting that. There is now the sales owing, the salaries owing. That means we have got people working for us and we have not paid them salaries, and that is why in the trial balance you're not seeing anything on salary. So we come to our statement of financial performance, and then we just write there salaries owing, salaries owing, and the figure there that we are having is 10,500. 10,500. So let's see, we were getting our gross profit, the net gross profit of 192. We were subtracting expenses. So what is our total expense? If I add 11 plus 12 plus 13 and plus 10, that gives me 46,500. So that means our net profit will be equals to now the 192 minus the 46,500, and we will have a net profit of 145,500. 145,500. So that is our net profit, 145,500. So that is now all for our KK statement of financial performance. The next bit now is to open up KK's statement. So let me just mention this, a statement of financial, let me just call it performance. This was our trial balance. Sorry, that one ought not to have done. I'll just mention it. This is our trial balance with additional information. Okay, and then of course that was just introduction. So let's come to our next in here when we'll now talk about financial statement of financial position. Statement of financial position. So once we have done that, then I think we will be up ready for action. So let me just come in again, copy this particular first part here. Let me just copy it, and so that it makes my work easier. So this is statement of financial position, not performance now, position. Okay, then it is not for the year ended, it is as at 31st, of December 2004. And of course now this starts with the non-current assets, and our non-current assets there we have, if we come to our trial balance, our non-current assets, we have, let me look at it, we have furnitures and fittings, and then the premises. So we have this. So let me just copy that. Let me just copy this and I bring it here so that I play around with it. We have that furniture. Then the other one that we have is a premise of 200,000. Control copy, and then I paste it there. So let me play around with this. Of course, we normally have the cost, and then we have accumulated depreciation, then we have the net book value. We normally have those particular But for this particular question, we've not been given anything on accumulated depreciation, neither for that particular one for premise. So we just assume our cost minus the accumulated will be the same figure, the same to the premises. So our total non-current assets will be 250. So if I add that, that is 250. Then we have our, let me just again push that so that I don't, okay. So we have our current assets, and our current assets, when we come to our trial balance, we have something called, of course, our inventory as at the end. So I come there and I say inventory, and of course we have that inventory, and the figure there for that inventory we have been given as 26,000. After inventory, we have our accounts receivable, which is 27,000. So we have our accounts receivable or debtors, accounts receivable, and our figure there is on the debit side 27,000. Then after accounts receivable, then we have let me just check it there. So we have cleared with that one. We have also cleared, let me just italize that, drawings, furniture and fittings to Madana Nayo, or we have a cash in hand. Then we have premises that we have also cleared with. So the next one is our cash in hand. Let me just copy it, then I paste it here, but of course this figure gets here. So we have that particular cash in hand. Then we check our trial balance just to see anything, our additional information, where the devil lies, just anything that is more or less an asset in nature. We have used 26,000. Rent accrued is not an asset, this is a liability. Insurance paid in advance is an asset. Commission due is an asset, this is our money. Salaries owing is a liability. So again, those are some of the things that we are now taking to the statement of financial position. So we have assets here is insurance paid in advance and commission due. So let me just copy them also, and I bring them here. So those ones are from additional information. So we have those ones as our assets, and I think that closes the list of all our current assets. So if I add them up, let me see if I add them up. So our total assets, current assets, is 65,000, and of course we are saying less current liabilities to give us our working capital. So current liabilities, there's accounts payable, the creditors that we are meant to pay, and the figure is normally on the credit side, which is 32,000. And then we have let me just check any, so hakuna ingine hapo kwa, there's no loan and hakuna long-term loan and any other things like that. So we come over here and we find accrued rent, and we have accrued rent there, and then we have salaries owing. Those are liabilities. So let me copy those ones. Let me copy this one, copy that, then I come over here and I paste it here, Control V. Then the next one is salaries owing. I was talking about copy paste, and now you see how accountants do a lot of copy pasting. Wacha nitoe easy number 3 and something, and then this one I also remove this number 4. This one I remove this word rent. This one I remove the word salary, the word 5. Yeah, so we have those as our current liabilities. So if we add all of them together, of course, so that will be a total of 45,500. So we again come over and now it is current assets less current liabilities. So that will give us our working capital. So the same figure here. And our working capital now is 19,500. Our working capital is 19,500. So this is the figure that we are adding to this, to the total non-current assets. So we come over here and we say equals to non-current assets. We are adding it to our working capital, and that gives us our 269. So this is our net assets and the figure there. So let me now make this bold. Let me then underline this with a double line. Yeah, so that comes to this, and then we are now saying the format tells us this is financed by, all those assets are financed by. Of course, the first thing there is our capital, and our capital to Leona as equals to, from our trial balance, the capital was 144,000. Then of course that capital we subtract drawings, ile pesa ya mwenye nani amechukua, mwenye biashara amechukua for his private use, that was 20,000. So when we subtract that particular one, we end up with 124, and then we add our net profit, or we subtract our net loss for whatever case that there is. But in this case, we had a net profit from the statement of financial performance, and the figure there was 145,500. So when we add that to these two things now, that plus that figure there, you get our 269. So let me bring it down here. We have our 269 there. So that again, I bolden that, and then I double line that. So at this particular point, we can comfortably say that our statement of financial position has balanced at 269,500, 269,500. Of course, our format says if we had long-term liabilities, that is non-current liabilities, we could have also listed them there. We could have also listed them there in their figures, and then sorry, ingekuwa hiyo sio hapo, the figures should be here. Then we could have added them there. Then we could have had a total there, a sum total there. That would have been our sum total. So this sum total would have been this plus this one there. So that particular figure there, that would have given us, again, if there was something again that would have come over here. But for our class, we didn't have this particular non-current liabilities. That is what normally happens if we have it. Otherwise, with those now many remarks, that marks the end of this particular lesson. I pray that we do more exercises, and we prepare ourselves for our coming cut, which will be on Monday in the evening, when we will be doing our cut to close this particular discussion. I want to wish you all the very best as we still go ahead and do our revisions, and I want to say may our good Lord bless you and bless you abundantly. Thank you so much.